Investments are any assets you buy where you attempt to get a profit in return for your money. The general idea of investments is for your initial capital to grow over time. And many investments also generate an income which you can receive or use to enhance your capital. Of course, most investments are long-term in nature. There are many different types of investments and they each have different characteristics. I just want to give you a brief overview as to the four main types of investments that we would typically advise our clients to use. So the first and most obvious is cash or bank accounts. I think most people are familiar with those kind of investments. They tend to grow very slowly and you generate an income from them in the form of interest. Ultimately, you wouldn't expect your capital to drop in value using cash style investments. At the other end of the scale, you have shares or equities. And they're designed to be much more volatile in nature. The capital will fluctuate in value, but you generally expect those assets to grow at a much faster rate than a bank account over time. You should also receive dividends, which is the type of income that's received from shares, and you can reinvest those dividends to help the shares grow in value over time. You've also got property, and most people will be familiar with property, usually in the form of a physical asset such as a house or a commercial building. In terms of investments, you can buy into a property which A, the capital value should grow, but B, would receive an income in the form of rent. As an investment, you can actually buy into collective investment funds which pull together various properties and aim to spread your risk through your investment. The final main type of investment is fixed interests or bonds. That's instead of buying a share of the company like you would with shares, you're instead lending money to that company. So your capital may grow over time, perhaps at a slower rate than shares, but you will also receive a fixed rate of interest or income from that investment. So they each have different characteristics and they can be blended together to make an investment portfolio. There are a number of general principles to follow when investing money, and you need to have them all in mind before you start so that you make sure that you understand what you get yourself into before you invest, but also that you regularly review and keep track of how things are progressing. The most important thing to remember when investing money is that there are no guarantees no matter what you invest in. And so what we're going to try and take you through in this video are some general principles to follow so that you understand how to invest and what to know before you start. Now, of course, it makes sense to have a plan when making investments. So the general advice should be to start with the end in mind. Think about what your goals are for that investment money. You know, what is the purpose of that money ultimately? What you're going to use it for? Think about whether you need access to the money along the way. So will you need to take occasional withdrawals, or will you be prepared to wait until that final future date to start accessing your money? And then the final thing is, do you need to aim for total growth on your money, or will you need income from your money? Of course, you can have both along the way. So think about your practical needs rather than just the goal of growing the money. What are you going to use the money for? How is it going to be used? And how are you going to access that money in the future? Now, it may seem obvious, but of course it's important to monitor and review your investments, and actually the two are subtly different. So you need to keep track of how your investments are performing over time, and you need to also take occasional time aside to review the progress of your investments over perhaps longer periods of time. So I think my general feeling is that you should monitor and review your investments regularly, but not too often. So what's a kind of a sweet spot between the two? So certainly it means don't monitor investments daily. I think that only leads to stress, as you will see investments fluctuating on a daily basis upwards and downwards. I think really the general trend of investments we would expect, but can't guarantee, but you would expect that investments should be growing over time. And so if you look at investments less frequently, you should be able to see that general trend in operation. Now, you know, in general, with most things, it makes sense to have an annual review, doesn't it? But you can take stock of how things have gone over a reasonable period that isn't too often. But of course, you can review things sooner if required, if your situation changes or something dramatic has changed in the stock market, for example. So we tend to have a 3-monthly sort of shortish review of investments where we just take stock of how things are going on a sort of top level basis and reserve a more detailed review for an annual update. So the term of your investment is the length of time over which you're prepared to invest. So it's very important to think about that before you start putting money aside. So in general terms, there's no guarantee with any investing, of course, but in general terms, investing is a long-term activity. It's typically over a 5-year period or greater. So generally the reason for that is that 5-year plus period gives you a good chance for your investments to have grown beyond the initial capital, taking into account charges and investment growth and the variability and the volatility of how investments perform over time. So of course that's not guaranteed, but the research does show in general that the longer the period that you're willing and able to invest, the less likely you are to lose some of your initial capital. And of course we generally expect your capital to grow over a longer period of time just through compounding. So think about the purpose of investments. Do you need access to your money? The longer the period that you're prepared to invest and not have access for, then in general the greater the risk you can afford to take, because you can ride out those short-term variability in the way that investments work. So but bearing in mind that your term might not be the time when you first need access to investments. So if you think about retirement as an example, you might retire at 60 and you might think, well, that's the day I'm going to access my investments, but you probably won't take 100% of your investments out at that point. So in fact your investment term might end up being another 20 or 30 years longer than your initial access point, because you're investing for the rest of your life, even though you're taking occasional regular withdrawals from that money. So putting all that together, you can see why it's not just perhaps an initial period of 5 years, it's a longer period that you need to think about investing over. Now, all investing involves taking some level of risk, even from no risk to high risk. So when investing money, the most important thing is to think about how to manage the risk that you are prepared to take, and also the risk that you'll need to take. And they could be two subtly different things, because the risk you're prepared to take may not match with the risk that you need to take. And so think about that before you start. So in general terms, the greater the risk you're prepared to take on average over time, the greater the return you should expect from your investments. And the reverse is also true. So if you're only prepared to take low levels of risk, in general terms, on average over time, we would expect your returns to be low as well. So one of the most important things to think about in terms of risk is the volatility of your investments. So volatility risk is simply the fluctuation on a daily or annual basis in the value of your investments. So some short-term low volatility investments might be cash, where you wouldn't expect your investment value to fluctuate at all, and that would be a low volatility investment. And a high volatility investment might be shares, where you would expect the capital to grow over time at a faster rate, but on a daily basis the capital value might be fluctuating quite wildly in value. So in some ways you can say that shares are high risk investments because of that volatility and that fluctuation in the value of your investments. Bear in mind that typically investments will fluctuate in value over time, and there will inevitably be some short-term temporary fall in the value of your investments on any given period. So you should expect that to happen, and the way to manage that is by having enough cash put aside to cope with those short-term levels of volatility. So just think about, when you're investing money, whether if there were to be a short-term temporary fall in the value of your investments, what effect that would have on your standard of living. If it's a long-term investment that you don't need access to for many years, then really that should be less of a concern to you. Whereas if you're taking an income from your investments and you're using that to live from, well, that should be a bigger concern for you, and you might want to hold bigger reserves of cash to be able to outlast those inevitable short-term temporary fluctuations in value. So think about risk before you start with your investments. So the risk of inflation is another important factor to consider in line with investing money. So inflation is simply the rise in the cost of living over time. So in general terms, if you have the same amount of money, after the effect of inflation, it's going to feel like less money over time. So that's an important drag on the performance of your investments over time. In simple terms, if you think backwards in the last 10 years, your household bills will have gone up in cost. And so if we don't take into account inflation in line with your investments, we could feel like we're having less money in the future, and it will mean that we're less likely to achieve your goals long term. So the most important thing to think about with inflation is the value of your cash holdings. So where we find people with too much cash, we find that their cash holdings are growing at a very slow rate, and typically the value of inflation is higher than the interest that you're going to get on your savings. So if you don't do anything with your cash and you have too much money in cash, you're going to find that money is going to feel like less value over a long period after, say, 5 or 10 years time. So it's important to have some cash to cope with emergencies, short-term projects, and those kind of things. But anything else really needs to be put to work to grow greater than inflation over time. So if you put that inflation into context, think about having enough cash but not too much cash, so that money is put to work to grow for your long-term future. So compound interest is an important factor when thinking about investing money, and actually can be your friend, especially in the growth stage of investing. So in simple terms, compound interest is interest on the interest of your money. So if you think about it in terms of a bank account, if you were to generate interest on that money and you didn't take that interest in the form of an income, if you leave that money in the bank account, next year your interest will be on the original capital plus the interest that you had in the previous year. So you start to get interest on interest each year, and the same works in any type of investment that certainly produces an income. So when we're thinking about investing money, we like income producing assets because they're more likely to create this compounding effect. So the same works with longer term investments like shares. They might produce a dividend for you, and if you don't take that money as an income, you can actually use that dividends to reinvest, and over time that generates an increasing value at a faster rate in your investments. So bear that in mind. It's a very important factor when thinking about your investments. So investment diversification is one of the most important things you should be thinking about before investing money. So this is one of the areas that I often see amateur investors kind of ignore or forget about over time. Generally what we want to do is produce a basket of investments that are spread around different types of assets, different geographical locations, and so on. And the main aim of this is to manage the risks, certainly in terms of the investment volatility that we see. So the main reason for this is that we can't be sure how any different asset is going to perform at any stage, and anybody who tells you that they can, you should be very wary of. So if we don't know how each asset is going to perform, what we do is we spread our risk by holding a number of different types of assets, and also a variety of assets within each type. So in effect, we're basically spreading our risk by holding a number of different types of investments. So if you think about it in simple terms, if you were to invest in one company and that company were to fail, then of course you would lose all of your investment. Whereas if you held 100 companies in equal proportions and one of those companies were to fail, you only lose 1% of your investment. So it works very much in the same way, but we spread across different types of assets as well as the number of companies we hold. So academic research shows that this can significantly limit the downside in terms of volatility, especially for more cautious investors, and we look to manage that risk versus return expectation by diversifying your assets appropriately according to the level of risk that you're willing to take. I think in general terms, a lot of people think that investing is about buying when the market is low and selling when the market is high, and that's what we mean by trying to time the market. And that, I think people think about investment volatility and how to take advantage of that. Well, I'm here to tell you that unfortunately that's a really difficult thing to do, and if you're looking for that kind of strategy, that's a very risky approach to take, and one which we wouldn't recommend. So I think in general terms, we never try to do this because it's almost impossible to get right. You might get it right one time, but another time you'll get it vastly wrong. And again, academic research shows that if you try and do this, you'll typically just be locking in losses when you get it wrong. So our approach really is a kind of a buy in appropriate proportions according to the risk you're willing to take, hold those investments for the long term, but adjust periodically, perhaps annually, to rebalance back to the ideal split of investments and asset allocation. So please don't try to time the market, because you really won't get it right, and really all that will probably happen is you'll end up losing more money over time than you would have done had you just held that money in the right proportions. So the charges and other costs on your investments are very important to consider, because effectively they're going to be a drag on the long-term performance of your money. So, if you think about the cost of investing and the charges that your product provider may levy on your investments, as well as the tax that you may pay on the capital and income of those investments, they're going to be a drag, aren't they, on the long-term performance, and that will compound up the longer the period over which you hold your investments. So, the lower you can get your charges in general, the more you're going to get to keep of the performance of your investments over time. So low cost is obviously good, because the lower the cost, the more you get to keep, but it's not the whole answer. And I think you should be thinking about how the investments have performed as well as the cost of the investment. So of course that can only really be done with careful research and more information. So in general terms, lower cost is good the longer the period that you invest over. So choosing the right product or the right tax wrapper is very important when considering where to place your investment. So the product is the way to hold your investment portfolio if you choose that way to go. So certainly tax-free wrappers are often the first port of call when you're thinking about investing money. What I'm thinking here is pensions and ISAs, because you're going to get tax-free growth on your investment portfolio, both in terms of income and the capital side of things. So typically I'm thinking you should be thinking about investing into ISAs and to pensions. ISAs will help you to grow tax-free along the way, and when you take your money out, it's going to be tax-free as well. So when you come to take an income or to withdraw your money, that will be tax-free. The downside is that you have to place money into the ISA once you've already paid probably income tax on that money. Pensions work kind of the other way around, really. So on the way into the pension, that money is probably going to come in tax-free, and you'll get some tax relief if you're employed, and that money is going to grow while the money stays within the pension. But the downside of a pension is there are complications on the way out. So you will probably end up paying some sort of income tax on your withdrawals from pensions at some point in the future. So of course the two work hand in hand together in a neat way. So just think about the type of investment you're looking to make, the product you're looking to put that money into, and how the tax implications will be, and the other flexibility options that you may have on those investments. So the final step in the process, once you've put together your overall strategy for investing money, is to research which investments to put into your portfolio. So this is where you're going to search the market to find investments that match your general criteria, such as the risk you're willing to take, the term you want to invest over, and the asset allocation you've chosen to match your general criteria. So of course there are a variety of free tools available on the internet in particular, and they may help you to put together your investment portfolio. I would say I would be slightly suspicious of investment research tools that product providers put together, because they tend to go down the line of the products that they're recommending. Another way, of course, to research would be to go through an experienced financial advisor who has access to detailed investment research tools that look into far more detail than you might be able to do on your own. And of course they can combine that with knowledge of the financial system and experience of how investments fit. And of course the most important thing they can do is to help to manage your behaviour in relation to the risks of the investments you're willing to take. So in summary, I hope this video has been useful for you to get started with your investments. Of course, there's much more information set out below on how these investment concepts work in practice, as well as sort of detailed statistics to back up some of these concepts. So if you've got any questions on investments, please feel free to contact us and we'll be happy to help.